So with the massive influx of prop firms nowadays, a lot of my mentees want to secure prop firm funding. Naturally, they don't have to put their own capital up to trade. They can just access one of these prop firm accounts and they can have access to potential income or salary from trading. So there is massive appeal in getting some of these accounts secured and passing evaluations. So naturally, as a trader, I've traded for the last 12, nearly 13 years now. I've started looking into this prop firm model and trying to work out mathematically the best way to get my students funded, and the results have been absolutely phenomenal. Now, prop firm trading, or retail simulated prop firm trading, is not necessarily the same as trading. In fact, it's something completely different, and I spoke about this at the London Prop Expo. Retail prop firm trading is trading gamified. It's not the same as managing money. If we enter periods of drawdown when we manage money, we have to spend time clawing back out of those periods of drawdown to get back positive. In prop firms, you could simply blow the account, buy another evaluation, reset and start again. It's a totally different game. And that's why in this video, I'm going to show you guys exactly how to play that game and maximize returns. Now, I've been lucky enough to be around some of the top traders in the prop firm world, and they've shown me their model, and this works really consistently. Now, for example's sake, we're just going to start very simply with two firms here. I don't recommend any firm. I don't know who is the best, who is the worst. I know from my students that get consistent payouts who the better firms are. Being with the more reputable ones is obviously important, but I've just taken two of the industry leaders here, Alpha Capital, FTMO. We all know FTMO probably have the market cap. That may change right now as I'm making this video. That's what's currently going on. And I would suggest if your goal is $100,000 of prop firm capital, I would never buy $100,000 of prop firm capital. I would always buy 4 accounts. So I would split my total amount that I want to achieve into 4. And the reason for this is we're going to use an account rotation method. But if we were to buy, let's say 4 accounts, I would diversify with 2 firms. And both these firms offer one-step accounts. Yes, there are consistency rules, but the way we trade and the way I teach my mentees to trade these prop firms is fixed risk reward. Now, I do also swing trade my own funds, and I've made a lot of money swing trading over the years. But the way I've made that is by dollar cost averaging into positions, pushing runners, having a max overall capped risk. And that doesn't necessarily fit this prop firm model, because the prop firm model means that you can't have more than 50% of your profit from any one day. Well, if you catch a massive swing trade, maybe you get a huge runner and that trade pays you for the year. That doesn't work on prop firms. You then need to make that profit again. So it's not over 50% of your total income or total profit. But the other issue here is that we have drawdown limits. So when we hit these periods of consecutive losses, which every single trader sees drawdown, when we hit it on our live funds, we have to work our way back out of that. When we hit it on a prop firm, if we have multiple accounts, we can simply write that account off and continue rotating this model. And that's how your favorite top prop firm trader is doing this and getting paid seriously from prop firms. So using this example, if we were to take FTMO, Alpha Capital, and we were to buy 4 accounts, the way I would run this is I would simply trade account 1 on day 1, and I would look for 1 trade. My model typically takes a 1-to-1 risk reward. It's high win rate. I usually can push it over 70% for long periods. We have periods where it drops slightly, but we also have periods where it pushes to the 80+%. But overall, if we can keep that around that 70% mark, even in the 60s, this account rotation method will get you paid. And what we're going to do on day 1 is we're going to just take 1 trade. Now, if that trade comes in, we're going to continue on this account, day 2. And this is on the premise that we take 1 trade a day, right? So if we take 1 trade, it comes in, day 2, we're on that same account again, comes in again, we stay on that same account. And we continue trading that account until we hit 1 loss. Once we hit 1 loss, we need to move to the next account. And when we move to the next account, we're then starting fresh again from that 0 balance. Same thing. We keep trading it until we hit 1 loss. As soon as we hit 1 loss, we move to the next account. And we continue this method until all these accounts are either passed or failed. Now let's look at some of the maths behind this. So if we're trading a 1-to-1 risk reward, I've got various win rates here. If you have a 50% win rate, your expectancy is 0. Minus fees is actually under 0. So you are break-even trader. That's a coin flip strategy. you have a 2.8% chance of passing all 4 accounts. You're going to average 77 trades, and it's going to take you around 39 days. Now, if you were to take a 60% win rate with a 1-to-1 risk reward, now you've got a 38.7% chance of passing all 4 accounts. This is pretty good, right? Average trade 71, 70%. This is where the odds completely shift. So the closer you can get to that 70% win rate, the easier this process is going to be. Because at a 70% win rate, you've got an 85.5% chance of passing all 4 accounts using that account rotation method. If we push the risk reward, you can see here a 40% win rate. Our expectancy per trade is 0.2R at 1 to 2. Now that means that we have the exact same expectancy as a 60% win rate at 1 to 1. So a 40% win rate at 1 to 2 has the exact same expectancy as a 60% win rate at 1 to 1. But at 40% win rate 1 to 2, your chance of passing all accounts is only 15%. Whereas at 60% win rate 1 to 1, it's 38.7. It's over double. That's why I always preach lower risk reward, higher win rate for prop firms, because this model proves it mathematically. And a 70% win rate at 1 to 1 is a very, very similar chance of passing all 4 as a 60% win rate at 1 to 2. If you can get near that 70% at 1 to 1, you're even doing better than a slightly higher win rate system, lower risk reward. If you can get as close to possible as that 70% win rate at 1 to 1, you have a great chance as a trader getting paid consistently from prop firms. And the obvious comparison here that jumps off the page is that 60% win rate at 1 to 1 versus the 40% win rate at 1 to 2. They have the same expectancy, but the 1 to 1 has wildly different outcomes, far better. Higher win rate keeps you alive longer, keeps you in the rotation longer, keeps you earning from prop firms longer. Now, if we look at this table here, prop firm challenge, 7 systems compared, right? And this is 50,000 experiments, Monte Carlo simulations of the 4 account rotation. And we're going to do 2% risk here. And I've done this based on the FTMO one-step rules. Now, FTMO one-step rule is that you have 10% max drawdown. Alpha Capital one-step rule is that you only have 6. If you're trading Alpha Capital with a 6% max drawdown, you have to do 1% risk per trade. FTMO, you can push it. You can go 1.5, 2% because it has that higher drawdown threshold. And understanding the rules around your prop firm is so important for designing this system. It's amazing how many traders just jump into prop firm challenges and don't fully understand the maths behind what they're trying to achieve. This is a business. And if you run it like a business and you understand your numbers, you will get paid. So if we're trading a 50% win rate 1 to 1, we know that our expectancy is 0. A single account pass rate is still 40%. This is how you're seeing some terrible traders, people that don't have an edge, that aren't profitable, still get paid from prop firms. Because if they're rotating enough accounts and they're just break even, they still have a 40% chance of actually passing and getting funded. Now, if they're then doing that on live accounts too, they have a 40% chance of getting paid. And the more accounts they throw into the rotation, the higher chance they have of getting paid. 60% win rate at 1 to 1. Single account pass rate is 79.1%, right? All pass we know is 38%, so that's all 4. But if we can then push to 70%, again, this is where it all changes. We've got a 96.2% chance of getting funded on 1 account and an 85.6% chance of getting funded on all 4. So there's a good chance we're going to get 2 or 3 accounts passed at the minimum here. Then if we compare that to a 50% win rate at 1 to 2, single account pass, 85% chance again. All 4, 53%. 60% win rate 1 to 2, again, 85% chance. Very similar to that 70% at 1 to 1, but a 95% chance that we get 1 account passed. So you can look at this maths and you can determine what's my edge, what's my win rate, what's my consistency, what's my average risk reward, what's my expected value, and you can then factor in how many accounts you're going to rotate, what position size to use on the trades, and so on. So all 4 accounts passed is the goal, obviously, but it's not necessarily the most likely outcome. The likely outcome is that we're going to have less than 4 passed. So which system wins out of all of them? Out of the 50,000 simulations here, and this is based on the FTMO model, Same if we were to base it on the alpha capital model, but except we would have to lower the risk per position. Well, you can see here the 80% win rate at 1-to-1 obviously is going to win. It's the highest one. But you can see that in second place is the 70% win rate at 1-to-1. If you can just get your edge as close to that 70% as possible, then you will make it as a prop firm trader. You will make a serious amount of money at 1-to-1 risk reward. And that doesn't necessarily mean you're great at managing capital. Yes, it's a profitable system. Find that managing capital, actually, you can push your risk reward based on your data to make more money over 12 months. That's not applicable here. It's not the same thing. This is trading gamified and trading prop. If you can follow these models, you will make money. Now, something else that's really, really important, and I think that so many traders fail to look at this, and this isn't just in the prop firm world, this is in account management as well. You know, if they are consistent traders, I've met consistent traders that can't necessarily tell me their chance of consecutive losses. And what's really important to understand is your average, your median, and your worst observed. So the average and the worst observed is the most important here, because if you have a 60% win rate, then your worst observed out of all those simulations over 1,000 trades was 21 trades lost in a row. Now, how many traders psychologically can go through a 21 trade losing streak and continue to execute their system efficiently and effectively? Not many. Equally, if you have a 50% win rate or a 40%, say you're trading that system with the exact same expected value as the 60% win rate. 60% at 1-to-1, remember, is a 0.2 R expected, same as 40% at 1-to-2 is a 0.2 R expected. But a 40% win rate, you are going to see on the worst observed experiment here, 33 consecutive losses. Now, that's not accounting just for the average. The average is you're going to see 12 consecutive losses. My experience here is that when I get a new trader come in, if I said to them, okay, I have a 30% win rate, 1-to-3, it's a massively profitable system, the chances are they're not going to be able to execute it because they're going to hit losing streaks. They're going to doubt my ability as a mentor. They're going to doubt the edge. They're going to tamper with it, tweak it. They're going to go and look at other strategies, start watching YouTube videos like you're doing right now, and try and figure out a different way of trading. And that's not the way to do things. What they should be doing is obviously executing the system over and over, regardless of the short-term outcomes. But it's very, very hard when you're new to trading to come in with that sort of mindset. And that is why I always try to push the higher win rate, the lower risk reward. One, because it keeps the newer trader engaged. They get conviction from seeing the system work. But two, because most of the people that I teach to trade now want prop firm funding. I have a handful of traders that are trading their own money. The majority of my mentorship now are prop firm funded. So if you have a 60 to 70% win rate, you're looking at 5 to 7 losses in a row on average. That's way easier to handle. I personally have had students that have quit my mentorship after 3 losses in a row. If I had an 80% win rate, I'm going to have 4 on average. So there is just no way. There is no system out there that exists like that unless you're doing negative risk reward, really high win rate. And then your risk of ruin, your risk of blowing up the whole account is 100% at some point, right? So between that 60, 70% is the sweet spot. And if you go on a really good run and you push 70 plus, 75, 80%, then you're going to get a lot of funding done very, very quickly. Also, if you're doing that on your funded accounts, your live accounts, you're going to get paid very quickly as well. So even with an 80% win rate, you can expect a max losing streak of 4 to 6 trades over 1,000 trades. At 50% win rate, a streak of 9+ consecutive losses is the median outcome. That means it will happen. Again, this is why traders always fall back to trading as a game of psychology. It's not really. It's more about knowing this. If you are aware of this and you know how it relates to your system, you then don't need to sit there and watch countless hours of YouTube psychology videos or read The Best Loser Wins Trading in the Zone 19 times. You've just got to understand your system, understand what you're going to have to go through and how you're going to have to be mentally prepared to go through that stuff. But just being aware of it is the main thing. When it happens, you then don't panic because you know that you already pre-planned and prepared for this. There is also a happy medium here because if you buy, for example, 50 prop firm accounts and you rotate them, you're going to be doing that for a very, very long time. So we want to find the balance between taking a long time to pass any of them, all of them, or however many, and actually having positive expectancy. And for me, I found that with my mentees, 4 is a great place to start. 5 potentially better, but will take a little bit longer. As you increase the amount of accounts you can buy, you have to also consider increasing the risk that you're taking per trade, because you don't want to buy 10 accounts and then sit on those 10 accounts in the evaluation stage for 6 months. It's a waste of time. You're not getting paid. The capital that you paid for those accounts is tied up. So you're down in money and it's demotivating. But the psychology of also having to increase your size per trade becomes quite difficult too. Because then if you feel like you need to take 2 or 3% risk a trade, maybe 3, maybe 4, then you're actually going to find psychologically that that becomes a little bit more difficult. You're looking at bigger numbers on the screen. You're blowing accounts much quicker because it could take maybe 2 trades to blow an account. So overall, there's definitely a sweet spot here. And for me, that sweet spot is anything between 4 and 6 accounts. Hopefully this video helps you guys get funding, because I don't think there's any reason why anyone should ever just be buying one prop firm account, even if you're a consistent profitable trader. I know traders in the city here that have a 28% win rate, but their average R is 1 to 12. If they bought one account, they'd probably fail it. And that doesn't mean they're not a good trader. They're managing huge amounts of capital and making steady annual returns. But understanding that this is a game and it's not about management of money, it's not about consistency over the long term and holding on to one account for 3 years. It's about rotating, churning those accounts. That's how you're going to get paid as a prop firm trader.